Hey, I'm Kerry Grinkmeyer, Best of U.S. Homes, Keller Williams in Birmingham, Alabama. Wanted to talk today. Today is September the 13th, and we're approaching the 10-year anniversary of what a lot of people say was the real start of the subprime crisis, which drastically affected the real estate market. Actually, the crisis started about 3 years prior to that as a result of bad lending and bad banking. The banks got in the habit of not really qualifying people for loans and putting some exotic loans together where people weren't really responsible for the payment of both principal and interest until sometime in the future. The industry kind of took the attitude that, well, we know real estate appreciates every year, so even if you couldn't pay the principal and interest and you could get the loan, 5 years from now you can sell the house for a profit. So we got into a lot of speculation. I bring that back to say, is that going on now? No, it's not. Banking is, at least for the residential markets, is pretty strict, and you've got to be qualified to get a loan. So I don't think that is going to happen again. I do think we have some bad banking practices that has gone on in the corporate area, and I'll talk about that a little bit later. But what happened is when the crisis did occur, and you can look at a graph and pretty much see the indications as to when the crisis was going to occur, and that we had some forewarning that it was. If you look at this graph here, I've kind of outlined kind of a history of our national debt, the movement of the Dow Jones average, and also then relative to real estate, the movement of the case Shiller average or median price of homes in the United States. And as you can see, the line here is when we went off the gold standard and basically said that the gold standard said at that time in 1978 that we had to have 40 cents of gold in reserves for every dollar that we printed. After that, it was basically said that that was no longer needed. The value of the dollar and the strength of the currency would be based upon the creditworthiness of the United States. So you can see that we went into, starting here, the red line, a wholesale printing of money to prop up our economy. And it worked, and worked quite well until the early 2000s when the dot-com bubble burst and we saw a decrease in the Dow. As you'll notice, it really didn't affect the real estate industry. It affected the people who owned the dot-coms that weren't making any money. We recovered from that, but we continued to increase our debt. And then in 2008, we went totally in on the subprime crisis. But what I want to point out is that there are forewarnings. If you'll do a little research on the subprime crisis, you'll find that Robert Shiller warned of a housing bubble in 2005. Now, he's the guy. He's, I believe, a Harvard or Yale professor, and he puts together this Case-Shiller housing index and matches it to the financial situations of the United States. So he warned of it in '05. I wanted to show you this graph here. This is the index itself. And as you go up here, he warned of it in the fall of '05. We didn't get the data until early '06. And you can see right there, we were on the median price of a home was climbing up to over $200,000 in the United States. And right there, it reported a little bit of a dip. That was the red flag that we all should have seen. That it leveled off for a period, and then, as you can see, it plummeted. Then if you look at this over here, what this is the blue line is national. The blue line is a composite of 10 cities. The red line is a composite of 20, and the yellow line is national. So the forewarning was there, but as you can see, we are back up to about where we were, and maybe a little exceeding where it was in 2006. But it's continuing to go up, and my premise is it's continuing to go up because the federal government is continuing to finance our economy. I think the best example of that is the price of Amazon stock. In 2008 down here, you could buy a share of Amazon stock for $80 a share. If you want to buy it today, it's going to be over $2,000 a share. Well, how does that relate to real estate or the economy or whatever? Well, we've basically raised our national debt from 2008, it was $13 trillion. To get us out of the debt crisis, the federal government started printing money. We're now up to 22 trillion. So that's an increase from 13 to 22 of about, 13 to 22 of about $9 trillion in in about 10 years. So the federal government is basically financing the situation that we currently find ourselves in, and I have no problem with that. If I did that as an individual, I'd be facing disaster because someday I'm going to die and somebody's going to have to pay off that debt. The government never dies, so we don't have a doomsday somewhere in our future relative to corporate debt. It's not a strong situation. When it will crash, it will be when you hear your senators and your representatives saying, we've got to stop this deficit spending, we've got to reduce the national debt, we've got to stop printing money. If you hear that, real estate is about to crash within the next 3 years. If you hear that other federal governments saying that we won't buy U.S. treasuries anymore because we don't feel there is a sound government behind them, a real estate crash is about to occur within the next 3 years. The other issue, as I alluded to a little earlier, is corporate debt. Corporate debt is handled a bit differently than residential debt. Most people with their 30-year mortgage or 15-year mortgage have a fixed rate. Corporations, in corporate financing, they go to the bank, and the bank rates them either a AAA or down to a B minus. So you have a AAA, a AA, an A, and then you go to a triple B, a double B, and a B minus. In order to stimulate the economy, a lot of corporate debt was financed, that is, in those B categories. Now, in a corporate debt, your interest rate is a function of prime rate. So as prime rate goes up, your interest rate goes up, and thus your debt service goes up. So where I think we have some tremendous exposure is in corporate debt. We just saw Toys R Us file bankruptcy for this very reason, that the retail situation has changed so dramatically as a result of e-commerce that they secured low debt but higher rates, and as interest rates went up just a little bit, they filed for debt bankruptcy. There are a number of corporations. Campbell Soup is one of them. They're on the ropes right now. So those are the kind of things we've got to be aware of. The other thing we've got to be aware of is the baby boomer sell-off. There are 79 million baby boomers, give or take a little for death, but the first one started turning 65 in 2011. Now, what we know as people age, they start to downsize. They want to start getting rid of their stuff. They start having estate sales, cleaning out their houses. and want to downsize. So they put their houses on the market so they can downsize or move closer to the children and grandchildren, or in many cases move into retirement facilities, smaller houses, less property. And so right now we have a situation where, particularly I know for fact in Birmingham, and as I've done research elsewhere, it's pretty well true. In Birmingham, if you have a house for sale for $150,000 to $300,000, there's a 77% probability that you will sell it over the next 365 days if you put it on the market today. Once you get over $500,000, that probability drops to 50%. Once you get over $750,000, that probability drops down to about 33%. So we're gaining a glut of homes on the market for higher price. This is going to create a different kind of bubble that I believe we've got to address. And that is, who's going to buy these homes? Well, as we move into 2023 to 2025, we're going to start the baby boomer die-off. Now we're going to transfer these homes, and maybe the baby boomer who is now 77 had decided, because they couldn't successfully sell their home in places like Greystone or Liberty Park or Highland Lakes or even Mountain Brook, they were going to age in place. Now that option is gone because they're dead, so they leave their house to their children. Well, the children already have a house, and in many cases the children live outside the community. And let's say they had their house on the market for $750,000 and it isn't selling. Well, the child living out of the community is now paying higher taxes because they've lost their homestead exemption. They still have to heat it and cool it. They got to maintain the yard, so it becomes a cash drain. I know this because I experienced it with my father. And I basically stepped in and said, look, we got to sell this house. I'm getting tired of writing a check every month to maintain it. So we dropped the price, and we kept dropping the price until it sold. It was probably a $350,000 house. When we were done, we discounted it by 30%. Well, now think what happens when you discount a house 30%. You have now just set a new comparable for that neighborhood. And if in fact that neighborhood is dominated by baby boomers who are dying, that is the level that houses now sell for. So what happens then is, if you were a millennial who bought the house at $750 and they're now selling for $600,000, you're underwater. That's a bubble. When is that going to happen? I suspect you'll see it happen sometime in 2023, 25, and then onward, unless the millennials step up and decide they don't want to live in the downtown areas, they don't want to live in the walkable communities, or communities like Greystone dedicate some land. I don't know what they do. Maybe they get rid of one of their golf courses and they build a Piggly Wiggly or a Publix, and they put on a Starbucks, and they create a walkable community, which that generation is looking for. Those are the things that are going to have to happen. Is there any precedent for it? Certainly there is. 7 years ago, Birmingham downtown was dead. It is now a vibrant community. So things change as attitudes, as demographics change, as people have children, people want to educate their children, these things change. So that's part of what's going on. That's where you need to what you need to be aware of. Please, if I can be of some help to you, get in touch with me. My number is 205-919-6006. My website is Best of U.S. Homes. We're trying to change the way homes are sold in Birmingham. So if I can help, give me a call, and I'll be talking to you again soon.